You want to talk about it?
If we want
I want to talk about it.
Okay.
I'm ready to get going. Are you ready to get going? Are we rolling?
Yeah.
Okay, well, we're here, Presidio Perspective. Let's get it going. Dustin, Jeff, Sierra in the house, ones and twos. Hit it. All right. Well, good to be back here in the studio with both of you. Sarah, we got to get you in the front of the house one of these days. People will just think I'm just talking to a wall back there, but she makes it all go down. All right. So, Jeff, always lots to talk about. You know, we're back here every 2 weeks looking across from each other. There's always so much to talk about.
It's choosing what to talk about because there's so much.
Yeah, right. I mean, we got the consistency here of the Presidio Perspective every 2 weeks,
Right.
And everyone's listening device and on their YouTube channels, etc. By the way, you can watch us on YouTube for those of you who don't know. That was a little call out that people said they weren't aware that they get to see us too and not just listen to us.
That's where the real entertainment happens.
Yeah, absolutely. I mean, you got to check out our hairstyles. You just don't know what we're bringing to the table every 2 weeks.
Just got mine cut.
Yeah, but then so there's things in life that are consistent and things that aren't, like the value of a dollar, the price of the stock market, and certainly the playbook for investing has changed dramatically, and we're going to talk about it today and on pretty much every future podcast episode for a while as this sinks into investors that the playbook for the last 5, 10, 15 years has dramatically changed, and we should all just be aware of what's going on and what we need to do.
Absolutely.
I mean, the name of the game in investing is to try to make money, right? And we want to have strategies that help us buy low and sell high.
Right.
And so oftentimes you're going to need to make new decisions, right? You're going to try to make more good decisions than bad decisions to win over time. Sometimes making no decisions is the best thing to do, and sometimes it's the worst thing to do, and you got to kind of get through the information and data and review that to make sure you know which one to do.
Well, we're going to have to clean that up because they might be confused by that.
Yeah.
But yeah, good points.
Maybe I'm just trying to confuse everybody to justify my existence here, but yeah. So, look, third quarter GDP numbers are in, earnings are in. We're getting through earnings season. We didn't have a Fed meeting to talk about. We talked about that last week. We got the record hot inflation reading, but markets seemed to shrug it off and looked into earnings. So, what's some of the economic data that's come in? Let's sift through that, and then let's talk about how we apply it to the investing world today.
Right. So GDP, we always wait for that, right? Quarterly number that comes out, third quarter GDP that came in today, which is, as we're recording, it's Thursday, came in at 2.6%, which consensus was, I think, about 2.5, so it was slightly higher.
Yeah.
And the components of it, I think, are what's really important. And
So this is the annualized rate. So they took from July 1, right, to September 30, by the way.
and they
right?
annualize it.
And then they annualize it.
Yeah.
And so that's the rate of what happened over the last 90 days, or really 120 days ago starting, right? So
Right.
it's mindful. So that was the 2.6. So not negative, right? Which would
No.
be
But as
a
good
recession.
point, in the past.
In the past, it doesn't reflect, right now.
Right.
Which is the only thing about recessions, right? I mean, you have to have 2 negative GDP quarters to call it a recession.
We used to.
We used to. Now that we're making up rules, right? Now it's like, what's the real rate, the nominal rate, So,
Right.
hey, if you grew at 2 and inflation was 8.7, or you grew at 2.6 and annualized inflation was 8.7, I mean.
Well, the data point that I gave you is a real return. It's
that
a
is real.
rate. It is real. However, I think you make a good point because the first 2 quarters were negative, right?
Yeah.
And it used to be the broad definition that everybody was abiding by the rule, which was 2 negative consecutive quarters of GDP was what we thought was a recession. So we had that. And there were some idiosyncrasies apparently that went into that as to why we had 2 negative quarters. And then a new narrative came out, right or wrong, and it came out and said, listen, there's a lot of technical things that go into the GDP print. So let's put that aside for a second and say, really what a recession is a broad slowdown in economic activity and employment. We didn't have those, so therefore we're not in a recession. So we could argue that we've changed the definition, whatever it may be.
Sure. Okay.
But I think you make it a good point, which is like we've got inflation, we've got all this data. I think we've got the Fed aggressively hiking rates. What's going on here? We can go through all this, and we'll do this quickly. But I think what we realize right now is that all this data is, a lot of it's in the rear view. So does it really matter? That's not necessarily. But what's going on here? The Fed is raising rates to tackle inflation and trying to slow down the economy, right?
Yeah, so the economy is growing at what otherwise might be like a healthy enough pace. I mean, not that big of a difference than years in the past. So we're growing, not by much though. I mean, this isn't a lot of economic growth. So I think people are concerned that the Fed is being too aggressive, like showing 2%, growth, and we're trying to dampen down the economy. It's like, how much of a margin do you have? And that's that soft landing, hard landing discussion. Like, it's a pretty narrow runway. You're taking a 737 and trying to park it on an aircraft carrier.
yeah, exactly. And that's really that's the trick.
Yeah.
Slow it down enough to bring down inflation, but not blow up the economy. And then the narrative starts to change, where all of a sudden the Fed, everybody's saying we got record low employment. We're at 3.5. Unemployment claims ticked up a little bit higher, but guess what? Not enough to slow the economy down. Then you've got the JOLTS report, which is job openings versus job. What was the total definition? I can't remember. Actually, you have to cut that.
No, leave it in there. No, leave it in there. Yeah,
because it's job openings versus.
It's okay. Everyone's tuned out by now. You can keep going. That one's. No. Hang on there, guys. Jeff's gonna bring it back. All right,
we're live.
But look, yes, we're doing it live, Jeff. We're doing it live. But so all of this stuff that we're talking about is, like we said before, it's the macro. It's like you're focused on all these economic data, and all these economists trying to predict what's going to happen, what the Fed's going to do with interest rates. Is it too aggressive? Is it not enough? And whatever. But at the end of the day, when it comes to our investors, what we want to talk about is what's the stock market doing, what's the bond market doing, what's real estate doing, where's all your investing. And so when it comes to the stock market, it comes down to what we've discussed before. It's corporate profits. These are professional money-making entities. Are they making money? What companies are making money? What companies aren't? Are those companies slowing? Are they growing? And then what is the price that people are willing to pay for things? What's the appetite for risk? And of course, you make the best deals and bargains when people aren't lining up at the market to buy.
Right.
So some of these times we look at these earnings, and some of it's good, some of it's bad, but the appetite to purchase, that supply and demand, gives you a good entry point, or at least a time not to sell, right, in some of these times, which is just ever important to remember getting through these murky times.
Right.
So what does the corporate earnings landscape look like so far? So we have all these Q3. Again, this is July through September. Always remember that. And here we are at the end of October, and they're saying here's what happened, 2 months ago.
Right.
And what's the consensus here?
Well, growing but slowing, coming down, and the analyst estimates have been coming down gradually, and they actually peaked in June, looking out to Q3 and Q4, and they've been steadily kind of coming down. So earnings are still growing, but growing slower than they had in the past. So as you talked about in the last podcast, corporate earnings drive, that's profits. That's the E. The P is what you pay for it. And so if you just look at corporate profits across the year, I know it's in the rearview mirror if you look at the last 12 months or 9 months and annualize it, but all of the losses in the stock market really have come from price. It's the price people are willing to pay because they see a trend in earnings coming down, and they say, well, I'm less optimistic, so I'm going to pay less for that.
Yeah, and that's also because I think people were lined up to pay for future growth. Right. And so there was like an expectation that it wasn't going to just, you can't buy something at 100 times earnings and just expect the earnings to stay stable. Right? You're going to need to expect those earnings to grow pretty significantly.
They are, to justify that price, absolutely.
Yeah.
And so you end up with the other side of things, which are you get to the point where, and I'm not saying we're quite there yet, but you get to the point where earnings become too cheap, or the price of the shares become too cheap because people are so scarred by having paid too much that when it's paying too little and it's a good time to buy, that's when kind of the mood starts to change and the market starts to kind of catch a bid and go higher. And it usually is already doing that before earnings have kind of bottomed out and the worst is already out there. The market starts to move. We talked about how that happened in COVID. I know it was a V-shaped recovery. Things were strange, but the market was moving up and the economy was going the wrong way. So you still have a growing economy, but the market's going this way down because
it's not growing as much. It's not growing in line with those expectations.
Right. So what happens when we have So we've got a couple Fed meetings coming up, right? We didn't have one in October. We've got midterm elections. We've got more CPI data coming up. We've got Q4 earnings. We've got all kinds of things that are just really at front and center about everything that drives markets. And yet we go out 10 years from now, we keep talking about that, and we went back and we looked at this very point in time, we wouldn't remember it.
Right. So getting through this
Is important.
But what you said is dead on accurate, and that's so important for us to remember. It's just like, yes, we're gonna have lots of Fed meetings, we're gonna have lots of elections, we're gonna have multiple different types of presidents and regimes and global conflicts and all this kind of stuff where the wall of worry is always going to be there. Right. It's a good chart to bring up. It's been a while. We should probably put it back up, and we've probably had a couple new ticks on what to be worried about.
Yeah.
But, as far as the macro is concerned, yes, all eyes are still on inflation. All eyes are on the Fed. And but we've seen some signs of the economy slowing down. I mean, you mentioned housing being the big detractor, right? All new investment in housing has dropped significantly. You say, 27.5% about or something like that. I mean, that's a pretty big fall.
And mortgage rates hit 7.
7. Yeah, highest
in 20 years.
Highest since 2002.
Yeah. So that's a big chunk of GDP. Yeah. Housing is a big, that the real estate component of the economy, that's a big component, and that's been a real drag, and that's what interest rates will do. Right. So
having your expectations on your housing, we've talked about it a lot, right? But we know that the prices of housing are coming down,
right?
And it's going to continue to fall. So we should have that expectation. And if you're not selling, just don't check Zillow for a little bit, right? But
exactly.
I mean, it's going to come down because when you have a 2-3% mortgage, so you're not selling because you can't go trade that and get a 7% mortgage and make that work,
right?
So you're just going to see that kind of continue for a while. So yeah, there's a lot of we see the that's kind of what the Fed is looking for there. PMI data is coming in, right? We're pretty neutral. Right, so the PMI above 50 says that we're expanding. Below 50 says we're retracting.
Yeah,
and that's the purchasers manufacturing index.
Yeah, exactly. It's just it's a good index to gauge goods
output production.
Right. You have ISM, which is services, and you have PMI, which is goods, and that was 61 last year.
November a year ago. Right, it's 61, way above 50.
And now we're near 50.
And now we're at 50.9, I think, as of the September reading.
Right.
So pretty neutral, right? And so,
but heading that direction towards
You've
contraction.
seen it precipitously fall, and at least not growing is kind of what the Fed was talking about, right? They're not saying we need to necessarily focus on an unemployment, going up, but want new, job openings to kind of go away.
Right, which is it is happening.
It's happening. Right?
So there's all these rates.
On this macro, the all eyes on inflation, and so you have to kind of look under the hood and say, okay, we see it starting to happen. All eyes are then on the Fed. When are they going to stop raising interest rates? So a lot of signs saying that, we could be close to the end of, what they're going to do to weaken the economy.
I don't know if you saw it, but it was in the Journal last week, and then the market kind of took off in the second half of the day on Friday, which was a mysterious rumor that kind of permeated the Wall Street Journal and other financial media outlets, saying that the Fed was considering maybe pausing after November, and it was basically hinting at the Fed getting a little bit more dovish or less hawkish and maybe seeing what's happening. Because again, you've got Governor Powell, and then you've got a bunch of other Fed governors, right?
Yeah.
And they all meet and they all vote on the open market committees and direction of interest rates, but they all have egos. They all get quoted. They all like to put in there, especially if they have a little dissension.
Oh, they have careers they need to build, of course.
Exactly. And if they're like, I really think we should be more aggressive, and I don't think that the message is, I'm going to say something.
Media loves it. We'll run with it.
So we're going to run with it, especially if it's contradictory to the kind of what the company direction or message is. Yeah. So somebody came out and said, well, the Fed might just kind of pause and see how this is going. And there was a little bit of merit to it in the sense that when you raise rates and you're trying to slow the economy down, it takes a while for that stuff to have an effect. It takes months, 6 to 9 months. So, you got some people saying we're not even close to bringing down inflation. You got other Fed governors being quoted saying, well, hey, take 6 to 9 months. I think we've gone pretty aggressive. Why don't we just kind of take our foot off the gas after the November 75 basis point hike and see what happens?
Yeah.
So goes to show you where the market mentality is, right? They're just dying for some kind of Fed pivot, right? To go pivot from being hawkish to dovish.
Meaning they're going to lower interest rates and
or
stimulate
just
the economy.
Or even just stop raising them.
Yeah,
at first,
that's
and then
step one. And then they let it continue to permeate and weaken, and that's how economies work, and we've seen it, and that's how we do things. So, okay, that's at some point in the future. We've talked about that. You know, we're not going to call the month, but we do know it's out there, and the stock market is a discounting machine looking to the future. The bond market as well. Real estate's going to usually lag, right? Because that's driven by consumer supply and demand, and so that lags, right?
You know what lags? We always talk about the markets. We talk about the bond market, but we don't really talk about the bond market. I'm
going to talk about the bond market today.
Good. I really want to, because that's something that's just, to me, the most interesting pocket
exactly
in what we're doing.
Exactly. So I want to talk about that, but I just want to comment on the stock market first. So, you know, people are still in this like old playbook of what's worked over the last 10 or 15 years.
Right.
And they go, oh, yeah, I remember when it goes down, I hold and it comes back up. And over enough time, you know, whether you're a bear or a bull, you pick your moment and you'll be right.
Right.
Okay. However, there's a whole battle to be fought in the interim. And you can be intelligent about how you allocate your capital, and asset allocation right now is pretty important. I mean, you know, one of the things that we do in our class, the 2-day retirement course we teach, is we look at the inflation reading from 1970 to today. And we draw the line, right, from 2022 hitting about 9%. And you look back and, you know, there's only 4 years in the last 52 years that we had higher inflation. And how does anybody look at that alone, just that, the inflation rate over that period of time, and say things haven't changed? And then if you look at the federal funds rate over the last 20 years, or even over that same period of time, how can you say that things haven't changed?
Right.
They have changed dramatically. And they're going, the future of investing is going to be different than what you've experienced in the past. And so there's work to be done, right? When you look at the top 10 companies of the S&P 500, you go, these are the winners. This is what I want to own. And as a decade passes, guess what? There's a new list. And it happens every 10 or 15 years, right? And companies have their time. And we're starting to see it, right? Because we report on that in our class. And so we have to constantly update it. And it's like it's a juggling act now. It's pretty consistent for a while.
Yep.
And you're starting to see these numbers drop. And these companies, I think Meta probably just fell out today.
I think it might have.
Yeah.
It's down 25%.
I mean, and so, you know, they were number 4 at the beginning of the year as far as market cap. And so you're going to have changes of what's going to work in the future, and it's not what works in the past. And then if you just look at the stock market today so far, and just because I'm looking at it today, but you look at the NASDAQ down 1.5%.
Right.
You look at the Dow up 75 basis points, 0.75%.
You don't see that very often.
You look at the S&P 500 down 0.5%. You look at small cap up 80, 90 basis points, almost 1%.
Right.
You look at bonds up, right, 0.5%. Stocks down, different pockets. You look at energy up. You look at technology getting hammered. It's different. It wasn't like that over the last decade.
No.
Correlations in different sectors of the S&P 500, I think, were like 99% correlated. Like, it didn't matter. Aside from energy, it really didn't matter. If you were allocated in the stock market, you were either all going up or all going down. Excuse me. You didn't see this bifurcation of depending on where you invest.
Right.
And so investors, as long as they were either participating, they did well, or if they weren't, they weren't. But it didn't really matter, you know? And so there wasn't a big difference of what you owned. And right now, there's just such a stark contrast. Now, obviously, the things that were working really well were all the big tech companies and communication services and discretionary spending and retail, and, you know, with those big juggernauts. And those are the things not working.
Right.
It's like, what's working? Energy, materials. Oh, those are all your favorite company. You know, when somebody wears like the band shirt, you know, And you're you got your albums there. You're like top 3 favorite songs, and so it's like the same thing, right? With like, oh, I love consumer staples. Top 3 favorite companies in the sector. Top 3 favorite material companies. Like, name them. I'm like, oh, I don't know, right? So, yeah, they're unloved. No one knows them. They've been thrown away, But like, these are the things that are making money. And so it's just important when you're looking at your portfolio today, understand the rules have changed. The game is different. Okay, how companies make money is important. You understand what this company does to make money. What's your vision of the future? Do you think that's happening now? Do you think that's going to happen over what time horizon? And then how are the multiples? Like, how much are you paying for that company? Is it 50 times earnings still? Is it 100 times earnings still? I mean, are you even considering buying something like that in this market when there is so much opportunity to buy companies that have really strong cash flows, yielding a lot of cash and money for their shareholders? Yeah. Maybe you want to consider buying some stuff that you've looked past over the last 10 or 15 years.
Right. Good point.
So anyway, there's lots of opportunity in these markets, and it's tough. We're down. People are like, well, I'm down. I don't want to sell. But again, it's not selling low and buying high, okay, which would be pretty hard to do since everything is low.
Right.
So you get the opportunity to sell low, but you buy low. And you're looking at, of course, what happened in the past has no bearing what's going on in the future. So I have to reallocate my portfolio, make sure I'm not too concentrated in any one pocket, right? Because obviously if I'm wrong, that's going to be very painful. It could be life-altering decisions that you're making on hope of this thing coming back or working out.
Right.
Yeah.
So let's talk bonds.
Yeah. When we talk about unloved sectors of people or sections of people's portfolios,
people just don't even want to look at it.
I'm going to throw it to you, but I that's the other thing I ask in my class. And so I have this crowd of people at UCI this week, and I'm like, hey, how many people here are excited about their bond portfolio? And of course, everyone's just shaking their head. No. I'm out of bonds. I don't even get bonds. I don't invest in bonds. And it's like, again, over the last 10 years, maybe there wasn't a lot of opportunity, especially not compared to the stock market. But we're pretty excited about bonds right now and fixed income. Or at least you are.
Yeah, well, we geek out on that. But yeah, it's definitely one of those unloved asset classes. And up until this year, I think a lot of investors, and the environment was such where bonds were there to provide a ballast against equities, the kind of equity market that we were experiencing.
Yeah.
And things have changed. And it happened at the beginning of the year. When rates go up, bond prices have to go down because they pay a certain coupon, right? A bond pays a coupon and it moves up and down to match the new bond that comes out. That's why bonds move up and down. So when yields go up, it's because interest rates are going up and vice versa. So what was bad for stocks was bad for bonds. But fast forward 11 months later, 10 months later, you're actually getting yield on your cash, 3%. Money market funds, you're getting 4, 5, 6, 7%, even higher in some of the bond classes. So yeah, you actually have a chance to earn a decent return just from the coupon component, the yield.
Yeah, so just to kind of further elaborate on that, because it's important. So essentially, if I lend you $1,000,
right?
Okay, a year ago, you would have paid me $20 a year, and 2%. That was the going rate. So Jeff, here's $1,000. Pay me $20 a year, and then in 10 years, give me my $1,000 back.
Right.
And that was pretty much what bonds were in fixed income, and why it's kind of like, I guess I'm supposed to have them, but they haven't really been doing much, right, in this bull market. Fast forward a year from now, and you own my bond, right? And you get $20, but now I'm paying $40, and so I loan $1,000 to Sierra, she loans me $1,000, and I pay her $40, right? So I'm paying her $40. So no one's going to buy your bond for $1,000 that only yields $20 when they can get it from Sierra that pays $40.
Yeah.
So you have to trade yours at a discount
to match that.
To match it. So you have to sell yours for $500. It's $20 divided by 500 equals that 4% that I'm paying Sierra. So that's what happens, right? I mean, when interest rates go up, the value of the bond goes down. Okay, so that's why you've seen your bonds and your fixed income portfolio down right now. But so now here we are, and we just quoted mortgages hit 7%. Well, what are mortgages? They're bonds.
Right.
You can buy bond funds that invest in mortgages. In fact, when you allocate to a bond fund in your 401k, you likely own a lot of mortgages.
Right.
Agencies and non-agency backed mortgages, and collateralized by real estate and loan to values and whatever, all kinds of stuff. But yeah, they're yielding 7%.
Right.
So what do you think is going to happen with mortgage rates when housing goes down, right? What do you think happens with interest rates when we go into a recession? Well, we've talked about it. That's the Fed pivot you keep mentioning. And so the interest rates go down. Well, you just said, here's what happens when interest rates go up. So, Jeff, what happens when interest rates go down?
Exactly. The bonds go back up.
So I kind of hear what you're saying here. You're making, you can loan money to the U.S. government for 1 year and make 4%.
Right.
1 year. CD from the Treasury, and they print money. So pretty sure I'm going to get my money back, right? 4%.
Right.
Which is also why there's a new normal in investing. Right. Let's come back to that. But so or I can maybe invest in mortgages. I'm getting 7%. And so as I'm sitting there getting my coupon, right? I mean, I'm waiting, and could interest rates go higher and that bond go down? Sure, right? But I'm getting paid while I'm waiting and getting through this time period here, and my fixed income's paying me real returns, potentially over that time period. And then when that Fed pivots, it's the opposite of what we said.
Yep.
And so if mortgages go down by, from 7 to 5, or 5 to 4, you're making a pretty good increase on the value of your bond, right, at that point.
Not to mention, if you own individual bonds or just bonds in these bond funds, and you own them in a taxable account, we talk about asset location, but your coupon, the interest you're getting is interest income, right? It's taxed at your ordinary income rate. But now you've got opportunistic bond funds buying these bonds at a discount.
Yeah, so
they're buying at 90. So now you're getting a nice rate of return, but you're getting a good chunk of it in a long-term capital gain because the bond's going from 90 to 100.
Yeah.
And so, I mean, not to get too much into the weeds, but there are some favorable tax advantages that can happen in a dislocation like this. And then not only that, getting back to the Fed, when rates are higher, it makes it easier for them to be stimulative again when they have to, which would be really good for bonds.
And I mean, that happens immediately. The fixed income market trades immediately, right? Because the stock market's pretty efficient and trades pretty quickly too. But lower interest rates, lower inflation would obviously favor longer duration assets. So if you can kind of think of technology companies that are innovating and going to make money in the future, it's not worth as much right now, given that you can make a guaranteed 4% loaning your money to the federal government for 1 year, or that inflation's 9%. So you telling me you're going to make money off in the future isn't that valuable to me, or not as much as it once was.
Right.
Interest rates come down, inflation comes down, those pockets of the stock market tend to do better, but that could also take a little bit more time. Fixed income's immediate. That those interest rates go down, that bond prices to that day, and it's higher, right? And so you should be pretty active in your bond portfolio. And if I haven't said it enough, stay away from these target date retirement funds. Stay away from mutual funds that invest in both stocks and bonds in a portfolio together, because you need to rebalance your asset allocation independent of your age or independent of it's December 31st. We're going to rebalance, right? When should you sell? When it's high. When should you buy? When it's low. And you're going to have some control over that in this fixed income market as interest rates go up and then down, and inflation has gone up and comes down, and you're going to have opportunity.
Yep.
Get your playbook together. This is a new world. You can loan money to the government for 4%. So when you are thinking about making an investment, whatever that investment is, that's the new consideration. Because it used to be 0.
Yeah.
There's
a new hurdle rate.
What's better than nothing? And so people are like, sure, I'll put my money in that. I'll put my money in that.
Because it's not earning anything in my checking account.
Now it's like, well, if the employment market's getting worse and we have inflation and these dollars are going to really matter, and there's lots of opportunities afoot. You have a lot of good opportunities. There's a lot of good options for investors today, right? So be choosy of what you put your money in. and what you have your money in. You have your money in allocated all kinds of stuff. Know what it is and be discerning, be choosy. You have lots of options, good options.
Well, lastly, just to touch on that, when you talk about things being different than they used to be, you still talk about 0% interest rates, and I don't know, you read it all the time, pushing investors out the risk spectrum.
Yeah.
Because you're not earning anything on your cash, they're being not as discriminate, and because you had a bull market, I'm just going to put it out there. But when you start to raise rates, then the risk spectrum starts to go the other way. And now, like you said, now you have a bogey or a hurdle. It's like, wait a second, I can just sit here and get 4%. Yeah, I know inflation's 8%, but it's now something, and it's looking more attractive than it did before, and that's important. And like you said, within the bond portfolio, there's so many things going on right now, and it's really setting up for some really good times. And not to mention, this period of bond returns is unlike anything in modern history, and when it snaps back, it's going to be pretty interesting, especially if you don't have your ducks in a row.
Yeah.
You like that one, don't you?
I do like that one. Yeah, get your ducks in a row. I want to take a shot at modern history. You knew where I was going with that. Don't set me up, Jeff. Yes. Hasn't been this good since your college days. All right. Well, I think we've given investors a lot to think about. We'll have more to talk about next week. I didn't even get to these tax brackets that you mentioned. We have expanded tax bracket opportunity with inflation, of course, coupled with the Social Security increases. So we'll have to roll that next week or 2 weeks when we come back in November for the Presidio Perspective episode. And the elections will have taken place, so we'll talk about that too.
I'm sure we'll have a lot to talk about.
Always do.
Yeah.
All right.
Good being here.
Take care, everybody.